Well, welcome everyone. I'm Bruce Ball. I'm VP of Tax for CPA Canada. As you may know, today's session is a follow-up to our previous webinar that we posted on October 26th on the CEWS subsidy program and the other COVID-19 related tax issues. If you haven't viewed that webinar yet, I encourage you to review that session first before viewing this one, because we are dealing with follow-up questions to a large degree on material that was discussed for the first time in the October 26th webinar. So after the webinar on October 26th, viewers were invited to send in questions for the CRA regarding the subsidy program and other topics addressed in that webinar. So today, CRA will be addressing the top questions that we've received, plus a question many of you have been asking about income gains and how to deal with them for the CEWS program. So joining us today, we have Randy Hewlett. He's the Director General for the Legislative Policy Directorate, and Kevin McKenzie, who's Director General for the Business Compliance Directorate. Before we get started, I wanted to make a few comments. First, many of you know that Bill C9 was just introduced on November 2nd. C9 deals with program revisions to the CEWS program that were announced on October 14th by the government. It also contains other changes to the program, some of which address some of the questions that we'll actually deal with today. And CRA has adjusted their responses to bring in the proposed legislation. Second, you'll recall the last webinar that the CRA provided income tax guidance on the forgivable portion of CEBA, the Canada Emergency Business Account. I wanted to make sure everyone understands that the actual CEBA program is not administered by CRA, so there were some questions related to that and issues around CEBA that weren't related to tax. Since CRA isn't running that program, we won't be able to deal with those questions today. CRA also added a question that we'll deal with as well on company vehicles that we have had in the hopper for a bit. So we'll deal with that one as well. So let's get started. We'll start on our first question, which is on the subsidy program, and it's for Randy. So in a recent technical interpretation, the CRA concluded that a mark-to-market valuation adjustment to the carrying value of an investment does not give rise to an inflow of cash, receivables, or other consideration. And this is in the revenue definition. So based on this, the conclusion was it wouldn't be considered qualifying revenue. So that triggered, I think, some questions that we wanted to pass on, which is essentially, more generally, can the CRA confirm how realized income gains or losses would be dealt with? So this would be adjustments, these would be actually realized gains and losses. And we'll assume it's not an extraordinary item. And in addition, if an amount is included somehow in qualifying revenue, how should previously recorded mark-to-market adjustments be handled? So Randy, I'll turn it over to you.
Thank you, Bruce. Not the way I want to start with a response, but this is one of those issues that the CRA is currently considering, and we're hopeful that we'll have a response very soon, and for which we will issue a technical interpretation.
Thanks, Randy. I was actually discussing the issue with CRA as well. It is pretty complicated, so we want to make sure we get this right. So we left it in because we wanted to make sure we give you an update on this and the fact it is being looked at. So our next question is actually on the treatment of CEBA. So there are various parts to this. So I'm going to just run through the various things that people have asked us to maybe expand upon a little bit, dealing strictly with the tax treatment of it and not the program operation. So as I was saying, the CEBA loan program created a lot of interest, so we did have some follow-up questions. So First of all, one wondered why a portion of the loan is really forgivable since it's only eligible to be forgiven. And I think the issue here was to maybe explain again or a little more depth on why 12(1)(x applies. Another person asked whether there's anything in writing that goes through the CRA's answer. In addition, we had another follow-up asking, I guess, how do you actually make the election to defer? So in the original webinar, there was a discussion that if it related to future expenses, there's an ability to defer. So the question was, how is that election done? And finally, there was again a ask for clarification on timing for the paragraph 20 sub 1 sub HH deduction. This is for a CEBA loan that isn't forgiven after all. So Randy, I'll turn it over to you.
Thank you, Bruce. So first, if a loan is an eligible loan to be forgiven when certain conditions are met, the loan is a forgivable loan. So a loan that contains criteria for its forgiveness is a forgivable loan at the outset, even when those criteria have not yet been met. The term forgivable loan is not defined in the Act. However, if you look at our income tax folio S1, F2, C3, scholarships, research grants, and other education assistance, dated April 26, 2017, it defines a forgivable loan as a loan which the lender is committed to forgive if certain conditions are met by the borrower. Next, if an election under subsection 12(2.2) to reduce the amount of an outlay or expense in order to avoid the income inclusion under paragraph 12(1)(x) has to be filed by means of a signed letter accompanying the income tax return for the year the forgivable loan is received, or for the year the outlay or expense is made or incurred, whichever is later. And you can find more information in our old IT bulletin, IT 273R2 on that. Next, if the amount included in income under paragraph 12(1)(x) or not deducted as an outlay or expense because of the election under subsection 12(2.2) is subsequently repaid pursuant to a legal obligation to repay the amount, a deduction can be obtained for the year in which the repayment is made by virtue of paragraph 21HH. Finally, a response regarding the tax treatment of the CEBA program has been presented at a CRA roundtable conference, the APFF annual conference in October, and will be released shortly to commercial publishers for publication.
Thanks, Randy. Now we'll move on to a question on the subsidy. We discussed this in the original webinar that there was an issue around CEWS elections and the fact that the current legislation at the time we did the original webinar wouldn't allow an amendment of elections. So the follow-up question, but I think there might be an update here too, unlike elections, can other subsidy choices be changed?
For CEWS purposes, elections and choices are treated differently, and an entity can amend a choice by filing an amended election form. Any changes must be reflected in the related attestation form RC 661. Further, the government has just released draft legislation that contains amendments to the CEWS legislation. Included in those amendments is a new provision that allows an employer to amend or revoke a previously made CEWS election, provided the change is made within certain timeframes. Under the proposed new rules, the change must be made no later than the date of the application for the first qualifying period in respect of which the election is made.
Thanks, Randy. And we have another subsidy question. This one's on baseline remuneration. Can you clarify CRA's position on baseline remuneration, whether that's changed? And I guess where this comment's coming from, it was suggested by one of the viewers that the original guidance was different than what was given in our last session. So maybe you could discuss that. And the follow-up was what should be done about submitted applications?
So thank you for the question. First, let me just say that we always encourage those interested to consult our website for the most up-to-date information because positions do evolve over time. And I would also note that we generally preface our discussions like this with that caveat. That said, if an eligible entity finds itself in a position where it wants to amend a CEWS election for a qualifying period to make a correction to a wage subsidy claim that was based on an incorrect baseline remuneration calculation, it can do so. The amended application form must be filed by the deadline, currently January 31st, 2021, as specified in the Income Tax Act. Under draft legislation just released, the amended application must be filed on or before the later of January 31st, 2021, or 180 days after the end of the qualifying period.
Thanks, Randy. Carrying on, another subsidy question, and this one deals with probably audits more now. We're talking about the statute of limitations. So how long does the CRA have to audit a subsidy claim?
Our general view is that where the CRA issues a CEWS notice, the minister is allowed a period of 3 or 4 years, depending on the type of entity, after the day of sending the notice. However, that time limit may be extended where one of the exceptions outlined under the Income Tax Act applies. For example, where misrepresentation has been made because of neglect, carelessness, willful default, or fraud in either filing the application or supplying information required under the Income Tax Act.
Okay, thanks, Randy. Next question deals with, again, more of an administrative issue. And the question was prefaced a little bit with a comment just to, and I'm sure we're all aware of this, that the subsidy rules are brand new and claimants are facing difficult times generally. And I think with anything new, there's bound to be things that need to be adjusted. So the question was whether or not the CRA will apply interest if a prior claim is corrected and the overpayment is returned to the government.
So if there is interest associated with a repayment because of a correction to a CEWS claim under the ITA, an eligible entity can apply to the CRA for relief from interest under the taxpayer relief provisions. At this time, there's no proactive relief announced. So under those taxpayer relief provisions, depending on the circumstances and on an individual case-by-case basis, relief could be granted from interest that accrued during the 10 calendar years before the years a request is made for any year or fiscal period for a partnership in which the tax debt arose.
Okay, thanks, Randy. I think one thing at our end, this is an issue we can sort of monitor as well, and perhaps depending on sort of the volume and what occurs, this might be something we can discuss later as well. But thanks for the answer, though, because that's helpful. So we're going to switch gears now and again talk about more calculation and eligibility. And the next question we had is for work in progress. So Randy, could you discuss the implications of WIP for the calculation of revenue, both in terms of current periods and prior periods for the subsidy?
Thanks for the question, Bruce. I'd like nothing better than to do so, but this is going to be one of those issues that we need more time to evaluate things, and we hope to communicate a response when our analysis is complete.
Okay, thanks, Randy. Well, one thing I'd suggest as well, if any follow-up or any information you need, let us know as well. It could be a question for clients, but it might also be asking about their own situation as well. So we can certainly help out if you have any questions around WIP and what's happening in practice with it. Our next question is on, again, the subsidy. And basically, the question is, should consolidated qualifying revenue of the affiliated group using the election available under paragraph 125.74B include all affiliates or only those with eligible employees? So in other words, eligible employers.
So where an election is made to determine the qualifying revenue of an affiliated group of eligible entities on a consolidated basis for a qualifying period, the qualifying revenue of all entities within the group must be included. This rule applies even if one or more members of the affiliated group may have no eligible employees in the qualifying period.
Great, thanks. Our next question is again around the calculation of revenue. So it goes like this. An eligible entity uses the accrual method without an election, but deviates from generally accepted accounting principles in their normal accounting method. Must they adjust the gap? And if not, could they use the election in paragraph 125.74 sub E to apply gap?
The qualifying revenue of an eligible entity is to be determined in accordance with its normal accounting practices. The election in subparagraph 125.74 is intended to enable eligible entities who use the cash method under their normal accounting practices to use the accrual method for purposes of determining their qualifying revenue. The election is not intended to enable an eligible entity who already uses the accrual method under their normal accounting practices to adjust how it applies the accrual method for purposes of determining their qualifying revenue.
Thanks, Randy. We have one last question on the subsidy. So here we go. Are 125.74A and 4B elections available for period 5 onward? And if yes, do elections have to be filed for all periods from period 1? The other question here was, is the ability to qualify based on the revenue decrease of an affiliated group, is the ability to qualify based on the revenue decrease of an affiliated group a period of periods 5 to 9, or is it only 1 to 4?
Yes, the special rules to calculate qualifying revenue under paragraph 125.74A and paragraph 125.74B are available for qualifying periods 5 and onwards, in addition to being available for qualifying periods 1 to 4. As noted in our frequently asked question 12.1 on our website, for certain special rules available for determining qualifying revenue, including those available under paragraphs 125.74A and B, an eligible entity may choose to apply a different rule in a subsequent qualifying period, provided that all the requirements for the application of that different period are met for that subsequent qualifying period. Please note that the government has just released draft legislation that contains amendments to the rules for calculating qualifying revenue under paragraphs 125.74C, joint ventures, and 125.74D, not dealing at arm's length. Under the proposed new rules, the election or choice available under these two paragraphs are available for qualifying periods 5 and onward, in addition to being available for qualifying periods 1 to 4.
Thanks, Randy. So that's the end of our questions on the subsidies. So we're going to ask Kevin now to answer a few issues or answer a few questions, I should say, on other issues. So Kevin, the first question we had is on employees with company cars. And the issue is these employees, many of them anyway, haven't been able to travel for business due to COVID. And they're going to have a higher percentage of personal use. And if you apply the formula strictly, a higher taxable benefit. Is there any relief? And I'm assuming the idea here is their personal use probably didn't change. It's really dependent on the changes because of their business use.
Thanks, Bruce. Okay, so yeah, we have implemented and announced some relief in case of certain employer-provided benefits up to this point. But with respect to the reasonable standby charge, right now we're not contemplating any relief. So in the circumstances you described, the balance of use changes for the employer-owned or leased automobile, and the standby charge would continue to be calculated in accordance with the formula in 6.2 in the Act. And so really the short version is if you can't get to the 50% or more business use for the vehicle, the standby charge, the reduced standby charge calculation is not available at this time. I'll just say, like, for more details on this, we have information in our guide T4130 around the taxable benefits and allowances, and that's on the Canada.ca website.
Okay, thanks, Kevin. One thing I'd mention just generally to everyone is that the answers from CRA generally on various issues really aren't governed on what's defined very clearly versus other things where there is some discretion. This is a formula, so I think that needs to be kept in mind. It's not the answer, I guess, some people are looking for, but it is the rules are fairly clear in the legislation. Our next question actually deals with social distancing and people who have been forced, I guess, or by arrangement have brought their vehicles home at night. So I'll read the question. That's probably the best way to deal with this. Is social distancing during the pandemic a valid business reason for making the employee take the vehicle home at night to meet the conditions for the lower per kilometer rate for the motor vehicle at home at night policy?
All right, thanks, Bruce. Yeah, this is a good one. So, I'll start out with the usual long-standing position of the CRA that travel between home and regular place of employment, other than a point of call, is personal driving. And we know that the regular place of employment is a location where the employee regularly works or performs the duties of employment, and the point of call is the place the employee goes to perform their duties, other than the employee's regular place of employment. But you've described a bit of a scenario, I know, in the background that we've looked at. So if the employee, and I think one of the caveats was someone providing a bit of an essential service, travels from their home to a regular place of employment or vice versa, and all the other conditions of the motor vehicle at home at night policy are met, we'll accept that minimizing the employee's risk of exposure during the pandemic is a valid business reason for the employee taking the vehicle home at night. And as such, the employer can use the reduced kilometric rate in the CRA's motor vehicle home at night policy. As always, like, to avoid being called an automobile, the motor vehicle continues to be used at the 90% rate to transport, goods, equipment, passengers in the course of business, after we factor in any other personal driving that the employee might be doing. Maybe I'll unpack this just a little bit more, Bruce, if you don't mind.
Sure.
May also be the case, depending upon the arrangement the employer has made, that the point of call provisions could apply. So if the employee travels directly from home to a point of call, returns home from the point of call, the employee's travel is considered business and it's not a taxable benefit. It always, has to be reasonable that the employee's travel to the point of call is made at that time, and of a reasonable route with respect to work at home. So we think maybe there's a little bit of flexibility here that we can provide as employers are adjusting their practices for their employees to provide as much physical distancing as possible.
Thanks, Kevin. And I guess it was I had two parts, and I think he answered it. So maybe just to reconfirm then. So will travel from home to a work site be in the course of business then, and not personal? Just to reconfirm.
Home to work site in the course of business. So if it's a point of call, right, it's not personal.
Okay. All right. Well, again, I wanted to thank Randy and Kevin, plus all the others actually who've been working to put this together as well. A number of people at CRA have been working on the answers in addition to Randy and Kevin. So I wanted to make sure that we thank everyone. And we also wanted to thank you for your interest and tuning in today to watch this recording. So given the time we had today, we weren't able to answer all the questions that we received. We tried to pick out the ones that appeared to be the more common or popular ones that people were wondering about. But that doesn't mean that we won't continue to follow up on some of the other issues that were raised as well. So we'll keep an eye on those and raise them where it makes sense. And we'll be looking at issues around the subsidy, employee expenses, and other COVID-related tax issues through our webpage. So look there for any updates as we go forward. So again, thanks to everyone, and we'll talk to you soon.